Hello and welcome to the Investing Master Series. My name is James Boyd. We welcome you on this June 23rd. This is live, but it's also recorded as well, and I'll share with you that playlist in just a moment. We also have with us many of you. We have Lido Len with us. Hello, Lido Len or Len, Dom, Ricebird, Bill, Pia, GT, Will, and many others. We also have with us the Ben Watson with us. Say hello, Ben Watson. All right, a little fun there. Now, just real quick as we get started, remember that Ben, myself, all of us coaches, we do post educational content on X. There's my handle, and Ben will post his in the chat. That way you can actually just click on it and follow him as well. Now, we want to hop right in. We had some volatility overnight in the Asian markets. And I want to kind of set the stage for just a moment, okay? Japan markets. Does anybody know how much they've been up in the last 2.5 months? Does anybody know actually how much the South Korean markets have actually been up in the last 2.5 months? So to give you an idea, to kind of set the stage, Japan markets have been up 45% in 2.5 months. They were down last night 5.98% on the index. So up 45% in 2.5 months, down 5.98. Now, South Korean markets were up slightly more, joking. They were a lot more. They were up 89% in 2.5 months. They were down 11% last night. So that affect our U.S. markets on the open. So we'll talk about that. Now you got to remember is if you ride a big roller coaster and you're going up a big hill, at the end of the big hill there is a drop. Now it sounds horrible until you realize how much those were up. Goal is not to give as much back as possible, right? But sometimes that drop does happen. We're going to talk about that, how that's affected some of the names that are in the paper money portfolio. Just want to kind of give us some context. Now, real quick as we get started, remember when we talk about examples, we will look at stock and option examples. When we talk about option examples, remember the options carry a high level of risk, not suitable for all investors. Understand that options are not all the same. Now, when we talk about the information that's done for general informational purposes only, when we talk about the paper money examples, we will actually look at those on the paper money software application. So we want to go through and practice together stock and option trades, good and bad examples. A lot of times we learn from the bad ones more than the good ones. Okay. Sometimes from the good ones we don't learn at all. Now, remember that investing involves risk. And when we talk about our examples, like short options, remember those short options, those can be assigned at any time. Always remember that, regardless of if they're in the money or not. Also, when we talk about if we bring up REITs, real estate investment trusts, they are similar to those associated with direct ownership of real estate. So understand some differences there. Now, when we talk about our examples, we'll talk about these market conditions first. Let's do that now. And then I want to kind of talk about some paper money examples, how the paper money account, some examples were pushed down, how to manage that or consider. And then we're going to talk about some new examples. Now, what I want to do just real quick is let's bring up just real quick. Let's start with the SPX, okay? Now, the SPX, it's down there's the SPX. Let me actually just set that, okay? And I'm going to kind of give us as much room as possible, okay? So here's the SPX. Now, the SPX, we said yesterday, it's top-heavy technology. Clearly, with that top-heavy technology, to some degree, some of the technology, not all technology, semiconductors being the strongest, the SPX, if we look at this yesterday, this is what it looked like yesterday. You might even say kind of a little neutralish range on the SPX. Today's price action, if we look at that, the gap down there, you're going to see that it gap down and so far is recovering. Again, U.S. markets reacting to what actually happens overnight in Asia. Now, if we pull up, let's say, the NASDAQ itself and say, well, what does the NASDAQ look like? Now, the NASDAQ, if we look at that yesterday, that was stronger. NASDAQ was within 1% of the high. And then today, that gap down, you're going to see that it's right there. Again, gap down, we open. So far, we've actually climbed back some. Now, it's not out of the woods yet, but it's trying to. The big one, obviously, with that is really if you look at the SPX, and I want to go back. Let me bring up the SOX since we're talking about the NASDAQ. The SOX, again, still in the upward trend, but now that was a new high yesterday, okay, and then actually dropped. Now, if you pull that up on that chart, let's say like a trend chart, that's where we are. We're trying to hold on to that 10-period moving average so far, but they gap down too. Again, kind of look at the Asian markets. Now, if we go back and look at, let's say, the SPX EW, the equal weighted, we also saw a drop. Did we see a trend change? I'm not sure if we can say it's a trend change. We are not going to say that, but it's definitely down to the diagonal line. That diagonal line is probably right there. Clearly, we need to hold the 84.15. Now, if we brought up, let's say, the Russell before we look at the big four, the Russell was a brand new high yesterday, okay, and closed there. And we see the smaller caps, they actually are still holding above the 20-period moving average, and so far it's bounced back fine. So far it's kind of looked like the high-flying ones, like the Asian markets and the semiconductors, did get pushed down. Now, kind of saw that a couple weeks ago, didn't we? Now, I want to also bring up, let's say, the big four. Yesterday, we talked about, is the VIX maybe starting to carve out a bottom? Now, we noted yesterday, and many of you mentioned in the chat, look, we can't say that's the biggest divergence we've ever seen in our life, because it's not. It did pop, obviously, on that news. Now, again, when this actually happens, the investor is thinking about stops. They're thinking about maybe risk management on their stocks, such as setting stops. They're thinking about, maybe, could I buy a put to protect a right to sell? Could I color the position? That is risk management for the position. Some might actually say, look, I'm going to buy a hedge on the market in general. The problem with that last one I actually said is your stock position and the market might be different. So understanding the risk management on your stock is huge. How to set a stop, how to maybe buy a put, how to actually maybe collar the position. That's if you had 100 shares for the collar. Now, if we look at the VIX right there, yes, it did gap to the upside. Yes, the moving averages look like they're going to cross. So we got to actually say right now, we're kind of on alert here, okay? Volatility trying to cross up. Now, historically, in the last little run we had, 22 was the high in the short term. Obviously, we're going to be watching those markets abroad. Do they actually taper down, or does that sell-off continue? If that sell-off continues overseas, we could actually could come right back here to the U.S. Now, also bring up, let's say, crude oil briefly. You look at the crude oil, that is still down to 73-ish. Well, that was a new low. Okay, we'll take that. And if you look at, let's say, the rates, okay, the CGI, and you look at that, that is not breaking out, but it does kind of look like it's trying to. That does look like more of your divergence. Now, remember, we talk about these four variables, right? Rates, the VIX, crude oil, and the US dollar. We said yesterday 3 of the 4 kind of look bullish. Now, if there's more bullish than not, equity markets tend to have a headwind. And it kind of looks like, to some degree, the equity markets are kind of having a headwind right now, okay? Now, what are we missing? We're missing the US dollar. And if you actually bring up the US dollar, that is going to be $DXY. Now, I want you to kind of think about this. Oh my gosh, that's even stronger than it was just a couple minutes ago. Now, I want you to kind of imagine that we had a US bank, and that US bank was, let's say, paying 4%, okay? 4%. And then you had, let's say, Europe bank. Let's say they were actually paying 3%. And then you had, let's say, an Asian bank that was actually paying, let's say, 2.5%. Now, let's imagine we ask the question, where do people want to put their capital? Well, they might say, I might try to put my money in US, okay? Now, number one is they're trying to get the higher potential interest rate. That's number one. Number two, they could actually also try to put their money, exchange it for their currency, put it in US dollars, and they're trying to make not only the interest rate or get a potential higher interest rate, they're also trying to get the price appreciation of the US dollar. All right, so maybe a little double whammy. Now it doesn't always work like that. Sometimes you might try to get a higher interest rate, but the price actually goes down of the currency itself. But right now, these investors are saying, look, I'm going to try to get a higher interest rate. Second, actually, I'm trying to get the price return. The risk of this, of course, is probably inflation. Okay. Okay. And also that the price doesn't go up. And probably flag the other one is liquidity. Okay. Now, what I'm also going to so of these, we see the US dollar going up. Now, if you see that US dollar going up, we know what that probably means. Some of those investors are probably thinking maybe bearish precious metals. Those precious metals really haven't been that precious. Silver overnight just, well, hasn't been looking as shiny as it was. So again, some people playing that correlation. And that's now playing out into the basic material space. If I brought up, let's say, AM or NEM, okay, these names, you're seeing that these are being pressed down. Now, you could keep going. You bring up silver ones, things like that. So what we're now noticing is people are kind of riding the US dollar train, trying to get a higher interest rate, second, trying to get the price return. And also, by the way, that correlation of US dollar going up, that oil going down, it's kind of back in that kind of that somewhat inverse correlation. And that's what people like, playing the correlation. Now, when we also kind of bring this up, I want to also now kind of just make mention of keep an eye on biotech, keep an eye on healthcare. Okay. Those have been the names. I say biotech more than healthcare, but biotech is underneath the umbrella of healthcare. Keep an eye on biotech. Now, what I want to do just real quick is I want to kind of talk about the paid money portfolio and kind of how this actually, sometimes that volatility can press some positions down. Example given, I'm going to bring up the margin account and I'm going to show the example of, let's say, how did the overnight action hurt some of the examples? Well, number one is if we had, let's say, semiconductor type examples, ADI down $33 overnight, okay? And that $33 pressed this position down to down 466. AXP, didn't really do anything. Caterpillar, that was down 38, okay, and chewed up a good chunk of that unrealized profit. Deere didn't really move that much. Johnson was a long call that bounced back. Coca-Cola was a long call as well, somewhat bounced back, not much. We'll close that. And you're going to see Love is a bullish position as oil actually stays down. You're seeing a little lift from that. That's positive. And you're going to see Monster Energy Beverage. You're going to see a little push. So the moral of the story is the biggest ones that got hit overnight is Caterpillar and ADI. Now that's of the stock positions. If you pull up, let's say Apple's positive. AMD, like ADI, is down. And this is kind of this is the risk, right? The risk is if someone sells the put by itself, that's negative vega. So if the price goes down and the volatility goes up, it makes the options more expensive to buy back if you did. And that's number one. And number two is the price also goes down. And this is just adding like salt to the wound. Okay. Number one, price goes down. And second, the volatility goes up. And you actually have a big turnaround on AMD here, which was positive yesterday. Okay. Now, if you also look at, let's say, something like C, that's actually par for the day, and on is negative. So the big ones actually were hit, or there's many of them, are the semiconductors. So not a complete surprise if we're talking about overnight markets, kind of influencing what we see in the U.S. as well. Now, what I want to do is just real quick, because I want to bring up a couple of these examples. Now, the first thing we talked about is risk management, okay? I'm going to bring up Caterpillar, and I'm just going to kind of show where are we now, and, well, is it going to be stomped out? So let's bring up let's bring up two or three of these. And if we look at, let's say, Caterpillar, we're going to go to the fourth chart in, okay? Now, if I go to that fourth chart in, what I'm really looking for is where are the day's lows. We did not have a target on Caterpillar. We're just trying to ride that trend. Now, if you look at the white line is an 8-day low, red line is a 10-day low, and a yellow is a 20-day low. All of these are at the same spot. We need some consolidation because what this is doing is it's going back 1 day, 2, 3, 4, 5, 6, 7, 8. And this 8 days is really going to be right here at the end of today. And you're going to see that this stop can be moved up a little bit, but that stop is still right there at 849.41. We need some price consolidation. We don't have a target, okay? So there is no reward to risk stop methodology, as we'll see in just a sec. It's a pullback from the high. But the bad part is it's given back about half of what the gain was as of yesterday. So going to play it out. Then that's the tough part, is to ride that trend. The investor is really allowing for price fluctuation. Now, I want to bring up just real quick, like the example of like Love. You go back to the example of Love in the IRA example. We did a cover call. We had shares of stock, and we said, hey, what we're going to do is sell a call against it. We speculated and said, could maybe the resistance, could we maybe hit the 50 area and consolidate? The IRA has a cover call. If we take a look at the position in the margin, you're going to see that that Love right there. It's just shares only. Now, it's kind of interesting to note that it didn't go down. It actually went up. And if we take a look at that position, it's just kind of grinding. Now, here's the thing. In this case, could we actually put on a target on this? Yeah. How do we do it? Well, let's bring this up just real quick. I'm going to right-click on this. Let's also update the stop, okay? Now, what I'm going to do is I'm going to right-click on that line, create a closing order, and I'm just going to say sell. I'm going to do with OCO bracket, which means we're going to have a target on it and we're going to have a stop on it. I'm going to click on that. Now, here's the deal. When we do this, actually, excuse me, in the margin, we actually do have that. Let me check the IRA. Did we do it in both? Oh, I was wrong. I was wrong. So in both, we actually have, sorry, I didn't link that call to the stock position. So in the IRA, we have the 50 call. Now, the question we got to ask ourselves is, do we need to do anything? Well, if we don't have 80% of that maximum gain, minimum 65% of the maximum gain, we're not going to do anything. And we're probably not there yet, because this call is only upside, it's only upside down $57 in the margin and the IRA. But let's imagine here that we said, hey, I want to set a target. Let's imagine the investor did not actually do a cover call like we did last week. Well, if we wanted to set a target, probably put the target right at 54, okay? And probably that stop underneath, probably setting a stop. Now, again, the con about these stops is these stocks, they went up so much in the last week, the 8-day low is low. So even a little consolidation would be welcome, okay? Now, that 8-day low is probably going to be at 40. Now, again, that sounds so low, and it is on a percentage basis and in dollar terms. So really, you want some consolidation here to get the 8-day low to move up potentially dramatically. Now, when we go back and say, well, James, on this covered call, what is the maximum gain on that covered call? Well, remember, bought those shares at 43.65 and sold the 50. So we know that basic math from 43.65, okay, up to 50, okay, and that's just going to be $6.35. All right, so that's not that bad. But remember, that's a stock appreciation. The call piece, how much was the call? Well, it's $1.67. So now we're just asking ourselves, what is the maximum gain? And that's going to be about, what, $8.02. Now check my math, please, okay? Talking and doing math at the same time ain't great. Now we're asking ourselves, this is what we can make at the maximum. How much do we have now? Answer, we have $543 of the 802, and the answer is we're not there yet. Okay? Now I'm guessing, but we're gonna double check that. We're at 67% of the maximum gain. So you get a little bit more. Now, we could kind of do that math in our head and say, well, if we got 80% of that 802, what would we need the gain to be? The answer is $660 or greater to say, look, I'm going to take that gain. When you say take that gain, what does that mean? Buy the call back and sell the shares. Okay? That's what that means. All right? Now here's the deal. are we now? Sam actually said bailing on an LUV. Well, here the thing is, we do have some tailwinds, right? We actually have number one is oil actually prices actually going down. The people that might have been wanting to buy tickets hasn't bought the tickets yet because they've been waiting for the prices to go down. So maybe the demand actually comes back. Now, when we take a look at this space just really quickly and just say, look, is love the only one that's going up, or is it kind of the group in general? So we talked about in love, maybe updating the target if we didn't have a covered call. We also talked about the stop, why that stop is so low right now. Consolidation is welcome. We also talked about checking out the covered call gain. Now, if we said, well, what is UAL doing? UAL is actually holding in there, but love being stronger. We pull up the DAL, Delta. Delta is not down. So right now we're really seeing love leading the way, as it should, and then Delta actually being number 2, and then actually United Airlines number 3. All right. Now, if you actually look at Delta, you're kind of seeing that old bounce, the old high turning into that new low. All right. So it's not up as much as love, but it's still holding actually in there. And again, showing some relative strength compared to some other areas of the market. Now, I want to kind of talk about just real quick a couple other stocks that we're seeing in the Dow. Now, what I'm going to do is let's kind of go back to this just real quick. If you look at, let's say, Apple, I want to kind of just show, kind of do a trade example and kind of talk about the differences here, okay? Yesterday, we did some examples of cash secured puts selling the puts by themselves. Now, that's great if the stock stays flat, or better if the price goes to the upside. All right, now, as we talked earlier, the price didn't go to the upside on 2 of those examples, and it hurt the positions. Now, I want to kind of just show you just real quick. What I'm going to do is going to go to the trade tab, and let's imagine the investor said, hey, look, I want to be bullish Apple, and I think the price could increase. Now, I want to kind of show you the differences, okay? Now, remember, if we sold the put by itself, now we're going to now go to the August expiration. Up until probably last week, we were doing the Julys. We're now going to go to the August because there's more than 30 days to expiration. What we're going to do is going to go try to sell a put, bullish strategy, that has a delta of 30 to 40. 40 being more aggressive, 30 being more conservative. Delta is telling us 2 things. The chances the stock could be in the money, meaning the stock below the strike by a penny, and also the delta being the change in the option price given a $1 change in the stock price, approximately. So think of it as a conversion. Now, what I'm going to do is I'm going to go down to the 630. Now, if we click on that 630, this 635 now, the 285 strike, if I click on that, it's going to bring up selling the put of the 285. Whatever put that we sell, that's where the investor says, A, I don't mind to buy the shares at that strike price or that stock price. Second, give me the premium. Now, you don't make the premium, you collect the premium, okay? We still got to see how the trade plays out. I'm going to right-click, analyze that trade. Now, when we do this, what you're now going to notice is we get that risk profile. Now, the biggest thing what I want to kind of bring up here is when you take a look at this, the position itself is going to show us what the delta is. That delta of the position is going to be, in this case, and let me just do break even, the August expiration. Now, if you look at this right there, you're now going to see that if we sell the 285, okay, and it has another position, let me go, it's not going to do that. Yep, it has another position in there. That's what's showing. But the biggest actually thing is it's showing us what the delta is, and it's also showing positive theta, and there's negative vega there, okay? Now, the biggest actually thing is that negative vega is if the volatility goes up, it pushes up the option price. The bad part is we already sold it, okay? And if we sell it and the volatility goes up, it's going to push up the option price. Now, how do we try to get around that? Well, we try to get around that by actually maybe taking this into a vertical position. Now, if we sell the 285 and then buy the 275, a $10 wide strike, what that's going to do is it's going to try to narrow that vega down. Now there's an offset here, okay? When you buy the put, what does it do? It pushes down the credit. When you actually push down the credit, it increases the break even. But the other thing it actually does is it lowers the theta, and it also decreases the vega. And that vega, if we actually take a look at this, instead of it being so negative, it's now almost neutral. So if someone says, why is someone doing cash secured puts? Someone does cash secured puts if they think the price is going to go to the upside and that volatility is going to be tame. Well, they're probably not going to do a ton of short puts by themselves if they think that volatility is going to be choppy and or rise. Okay? You're trying to de-risk. You're changing the strategy. Now, in the current market, if we saw that volatility goes up, number one is we want to try to be protective. Number one, have a built-in max loss. That vertical gives a built-in max loss. Number two, we're trying to be... Bill, I kind of still think about what you told me that one day. Neutralize is the word I'm going to use. Bill has another way of explaining it, which I'm not going to say. Okay? And so now the big thing is, yes, that credit looks so much better, but it has a bigger return for a reason. There's more risk with it. Now, what I'm going to do is in trade number one here, we're going to come back in and go trade tab. We're going to go Apple. And what we're going to do in this case is we're going to right click on that. We're going to go to the August and we're going to go to right here. And we're going to right click on the 285 and then now go to the 275. Okay. Now, when we do this, we got to ask ourselves the question, could the paper money account take that risk? Now, 285, 275, there's the credit. Now, remember, that's the obligation to buy the shares at the strike price from now until expiration. Now, so if you bought those shares at 285 and you collected the 235, the break even is at 282.65. Now, here's the deal. Just like we saw with two of those semiconductor stocks, if we have a big price decline overnight, you could actually have a decent chunk of that max loss overnight. Now, if you get the stock to go up dramatically overnight, you can have a big chunk of that potential max profit. Whenever that max loss is bigger than the max profit, you know that it's a probability type trade. Also note the commission. We're going to do that right in that account right there. And now what you're going to see in this case, we're going to send the position. So trade number one there is we're going to go in and do a short put vertical. And the purpose of me showing this is to help you understand when to consider changing strategy. You start to see the market being a little choppier condition, or you think that VIX could rise, be very, very careful selling puts by themselves. Okay. Number one is it's going to actually tie up more capital. Number two, you could have price risk. And number three is you're at risk of the volatility rising, making that option more expensive to buy back. And third there, you're probably not going to get as much time decay as you thought because the volatility is thwarting that theta decay. All right, now let's also go back to a couple other positions. I want to kind of bring up a couple stocks that do look a little alarming, okay? Now, one of the stocks that kind of looks a little alarming is Cisco. Cisco's just kind of holding on to a ledge of support. You got to imagine if the investors were in that position, their stops are probably right underneath 117-ish or so, right? Now, the other one that's kind of getting a little pressed down, and I'm going to fast fire a couple that, you know, these might be the ones that take the next leg down. Zscaler, you know, here it is, was at 336 down at 126. You know, is this going to take out the 120 floor? Okay. If we take a look at Adobe, I mean, Adobe up $2 today on a little lack of correlation in the market, but it's just been waterfall to the downside. The other one that we got to include right here that has also had some kind of a bearish trend, Autodesk. The other one that's been asked a couple times, so I want to kind of make mention of it, is Netflix. I mean, are people going to watch Netflix anymore? Okay. If you look at Netflix, you just made a fresh low on that. I mean, where's that going? We had that 10-for-1 stock split and it has been horrible. Okay. Now, if you look at it also, we mentioned, I'm also going to make mention of Workday. Okay. Workday is also another one that's kind of right at a floor. So now some people are not bearish investors. They don't like to take bearish trades. Now, so not everything is bullish. And we need to note that, okay? Call a spade a spade. Now, if you look at this, if we go back to also, let's bring up a couple examples. Now, we know that when, let's say, things become a little bit more volatile, people sometimes change what they're trying to buy. Okay, now, if we looked at, we know that historically, this is not new, okay? If there is more volatility, okay, somewhat, we tend to see people try to buy maybe biotech, the industry group. And we always kind of say that maybe area might be a little bit more less correlated. Some people throw in the pun of it's more immune. Okay, I won't do that because I've said that before. Utilities, staples, and healthcare. We would also include real estate, as we'll see in just a sec. Now, not all of them, but those might be the fishing holes, if you will, that some investors try to look at. Now, when someone looks at AEP, they're thinking, well, yeah, it's just boring. Sometimes the reason why you're buying certain things is you're trying to buy something that is not as volatile on purpose. All right. Now, I'm just going to flash a couple stocks, and then we're going to look at a couple and do some trades. Now, AEP kind of showing a little reversal. Its twin cousin, EXC, not as getting as much of a reversal as AEP. Now, if you looked at also the other one, just real quick, Target or Target, that one also kind of looks like it's trying to hold up pretty well. Okay, we'll come back to that. CL, Clorox, or excuse me, CLX would be Clorox. CL is Colgate. That's kind of trying to show a little reversal. Mo Altria, little kind of swing trade, right? Buy low, sell high. You look at PG, Procter & Gamble, not getting reversal yet. USB, if you look at that, that doesn't look bearish, okay? You pull up also GE, General Electric. It's had a pretty strong move to the upside, kind of sitting right at this little breakout area. And its twin cousin, the GV, getting a pullback. We talked about that. Pretty much went up near the target, and that's now kind of pulled back some. Now, the other one I want to kind of make mention of just real quick is Well, okay? Now, Well, this is now getting into what we talked about in the disclosures of this is a REIT. Now, let's start here for just a second, okay? Now, when you look at Well, whenever you kind of go into an area that you're not used to, look around, okay? So first off, when you go to the trade tab, just real quick, what's the volume so far? 706,000. Now, if you take a look at, let's say, the charts, you go back and look at this, there is periods on this chart where it kind of goes sideways a little bit. Chop, 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 chop. We go back to the analyze. We go back to fundamentals. And what I'm trying to really kind of see right here is some information about revenue or sales. I'm also trying to see information about dividend and earnings. Sales per share, it tends to be kind of more consistent. Now, if we're a growth investor, we don't care about per se consistency because that's not what you're looking for. You want growth, okay? Yet we want consistent growth, but not just consistent by itself. Again, people buy different things for different reasons. And what you're going to see is the sales revenue. That's been pretty consistent. Now, when you look at, let's say, also the earnings per share, it's actually been, for the most part, still positive. Not every year, though, up year over year. They focus on rental housing for aging seniors. Okay, now, what is aging seniors? Is this for anyone that's breached 40 years old? I don't know. So now here's the deal. My point is this. Whether the economy goes up or down, or let's say semiconductors go up and down, what does it have to do with rental housing? Not a whole lot. And this is why some people like to diversify some things in the portfolio. Okay. Now, obviously, with the earnings, we need earnings to pay some of those dividends, or would at least like to. That dividend over time has gone up slightly over time. Some people like that. That dividend information, go back to the trade, pull this up. You're going to see that quarterly frequency. It's not a big dividend yield, but it's some. Some people would rather have the price appreciation than the dividend. You get to decide. Example given that we're going to do is we're going to pull up this Well example. And what I'm going to do is on Well, I'm going to type in that. And what we're going to do is we're going to, obviously, if someone's thinking about that they're going to buy here, They think they're trying to buy it in the dip, and they're thinking that the price might try to break out. Now, here's the deal. Sometimes what happens is everyone just stacks their portfolios of semiconductor, and it's kind of like when it goes up, if it did, it could be amazing. When it goes down, it's like a famine. This is why spreading capital out, 3 to 5 different sectors, having some growth, some income slash value, that way if the growth struggles, there's something else in the portfolio that might try to offset. Okay? Now, I know when it goes up, you're thinking, man, forget that. I wish I just stacked it all in semis. Yeah, that sounds great until it goes down. Now, I'm going to right click on the chart, and then we're going to go to buy custom, and I'm going to go with stop. Now, what I'm going to do in this case is we're going to set the stop. Now, remember, we've been talking the last couple of days about these red and green candles. What does the red candle signify? Where it stopped going down. What does the green candle signify? Where it started going up. And we're going to mark, and where do we mark? We're going to mark at the open of that green candlestick. Well, that green candlestick is really at 207.82. So I'm going to put that stop right at 207.82, less 2%, and it's going to give us 203.66. Okay? 203.66. Now, if you don't mind, I'm just going to kind of double check that just real quick. We'll punch those numbers. What do we got? 217.81, support 207.82. When we look at the stop, 203.66, which is right. Dollar amount risk, 14, 6.49. Now, so we're going to do the example. Second example, first example was a short put vertical on Apple. Okay. Second example is a real estate stock, Well. Okay. And again, it's rental housing. And what we're now going to go ahead and do is go confirm and send. And notice it's saying if it goes to that price or less, sell the shares. The risk is we don't know what the fill is. Now what we're going to do is go back and put that right there. Now, yeah, the comment was, Sam's a funny guy. Okay, that's his wife is probably listening too and said, don't egg him on. Okay, now here's the deal. We kind of said on this one that Well was actually rental housing for aging seniors. Okay, yeah, we didn't say nursing homes. Now, they might have that in that portfolio. Okay, have to dig into that. But I kind of said in this case, it was people. I was joking. Maybe it's people for 40 and above. It just depends. Okay. Now, if we look at this, let's also go back to this. Okay, and just having a little fun. And it's always fun to have that little bicker back and forth. Now, let's go back to just real quick Target. Now, again, Target's been one of those names that, it's kind of had that upward trend. Now, people like to also go back to, let's say, a weekly chart, 3-year weekly, okay? And if we look at, let's say, Target, this is what the trend looks like. Now, it was down here, and it just kind of slowly grinded to the upside. Now, remember, the whole moving averages, the good thing is they're fast. The bad thing is they're fast, okay? If we slowed this down a little bit and said, could we just go back to maybe like a 10-day exponential or a 10-week exponential and a 30-week exponential? Yes, this is what it looks like. Now, why is this of importance? Well, because for many investors, they like to kind of at least see that on the weekly chart, there is a pattern of a pre-existing historical trend. The red line, the 30-week moving average, still pointed up. Second, the 10-day moving average, 10-week moving average, that is still pointing to the upside. Now, that is the foundation. Now, when we actually go back and look at, let's say, the daily chart, we're asking ourselves, do we have something on the daily chart where we're still seeing a bullish move to the upside? Now, if you take a look at this, let's imagine the investor says, look, I want to actually do something where it's more sensitive to price direction. Well, if we said that, we're thinking long call, long synthetic, buying shares of stock. When is the earnings coming up? That earnings is on 8/19. So it looks like it's around the corner, but you got about another 2 months, okay? Now, because we're looking at a weekly chart. Now, if we went back to the 1-year daily chart, this is what it looks like, and we don't even see the earnings. Okay. Now, what we're going to try to show on this is we're going to right click, buy custom, and we're going to go with OCO bracket. Trade number 3 example. We're going to actually, now let's put that right in that paper money account so we could actually track that. Okay. TGT. And now what I'm going to do is I'm going to right click on that, buy custom, and I'm going to go with OCO bracket. Now, if you look on the chart, there is showing today, so far, a close above the high of the low day. This is really on step number 1. So if someone says, I'm going to consider buying on step number 1, that's the earliest sign of potential. Some people might say, I want to see more confirmation. Understood. Now, if we went back and looked at this chart and said, where do we see resistance on this chart? We don't see any resistance on this chart on a 1 year. Going to have to go to the 3-year weekly. And that 3-year weekly, that ledge, we really got about, well, if we could look at this old ledge, let me cancel that. That ledge right there is about 141. The middle of that is about 148, 47. And you have, let's say, right there about 157. Now, so if I kind of put this, and I'm just going to put this as a marker, okay, 141. Now, if someone actually kind of sees that channel, they might be thinking, James, I'm going to take the middle of the channel, maybe 148. Noted. Okay. I'm going to go data GTC, data GTC. Good till cancel. We're going to go back and actually take a look at this. And I'm going to put the dollar amount. We said no more than 8% of the capital. 164,871. What's the most we could do? 13. Okay. And so what I'll do is I'm going to put that number right there. There it is. That's going to be about 96 shares of stock. Now, you know where we're going to go next, right? If we're that close to 100 and it won't break the back of the portfolio, the investor might say, James, I'm just going to do 100 since I'm 3 shares away. Why? Well, some people might want to do a cover call or consider if they were liquid. So trade number 2, I'm going to put an initial target 141 with really the idea that if that goes up, probably going to move that to 148. But I'll just put that marker there initially. The stop underneath this, if we go back and look at that 1-year daily chart, we look at that underneath. Now, some of you might not like kind of setting stops that tight. You might say, James, I'm going to set my stop underneath this low. Now, there's a good and the bad about a stop. The good thing is it's a trigger to sell. We don't know where it's going to fill. The biggest thing is if the stock goes down to 125 or lower, we don't know if it's going to go down even further. Had a nice little discussion yesterday on, do all investors set stops? And the answer is no. Some people want to have a set allocation and they want to just try to get exposure to that allocation. And they're going to take the volatility, okay? And they might say, James, I want to have 5-10% of my portfolio in REITs or in utilities or income areas, and come what may. Okay. Now, with that, there's volatility. Okay. You don't just get the ups, there's ups and downs. Okay. Now, in this case, what I'm going to do is going to set that stop at 125.41. Okay. Now, the comment is just real quick is let's go to the questions. Okay. Let's take 2 minutes, hit questions. One of the questions was, could we go back and look at, so that's the stock trade on target. Could we go back and look at the short put vertical, since you joined late, welcome, on Apple? Yeah, that was the 285, 275 for the August expiration. Now, we did choose to do that in this account so we could actually do a $10 wide spread. Okay? All right. Any questions there? Okay. Any other questions that I missed? Okay, I'm just looking to see if I miss any questions. Now, the other one just make mention of is we did make mention of the GEV. The GEV did drop here today. Now, guys and gals, the one thing that we really tried to teach very specifically is every drop is not bad. You got to understand that sometimes on a 10-day exponential moving average and a 30-day simple, it's not unusual every maybe 4 to 6 weeks to get a drop down to the 30 period moving average. That drop for many investors, especially if you're an intermediate investor, that's the moving averages that the investor tends to be trying to buy off. Not everyone is comfortable with buying off shorter term moving averages like the examples that I show. Okay, so just always remember that. Now I'm out of my time here today. Uh, Camera May will be coming up next with Getting Started with Options. Want to also say thanks to Ben Watson for answering those questions in chat. Also, quick reminder if you don't know, this actually class is posted on YouTube. Our channel is called Trader Talk Schwab Coaching Webcast. This class also has a playlist, and you're going to see that playlist is right there where you can actually follow that playlist, bookmark it, and you can see prior classes that we actually did for this class. Okay, so think like TiVo. Now, also with that, remember that our examples were stock and option based. We talked also about the effects of volatility that we saw overnight. We looked at also a couple examples of kind of how the volatility is playing out on some of the positions on stocks and options, and then we did 3 new example trades as well. Thanks to Ben Watson, and stay tuned for Camera May coming up next. I'll be back on tomorrow with Trading Growth and Value tomorrow at the same time, same station. So again, thanks to Ben Watson again for helping out in chat, and this has been the class on Investing Master Series. Have a great day. Stay tuned for Camera May coming up next. Bye-bye.